Welcome to this wealthmanagement.com Fast Chat. I'm David Armstrong, the editor of wealthmanagement.com. And today we're speaking to Todd Alston, who's the chief investment officer and a portfolio manager at Parnassus Investments. Todd, thanks very much for joining us.
Thanks, David. It's great to be here today.
So 6 months ago, we spoke and you saw the Fed raising rates and you saw the economic slowdown and you foresaw a possible recession. Some of that seems to be playing out, though to my mind, I think there's a lot less clarity about the direction now. But what's your view?
Well, we're still consistent with that view. And when we think about what's happening is when the Fed started raising rates last year, we've seen the fastest rise in rates that we've seen in decades. But there's a lag effect to that. So we think now, starting here this summer into fall, we're going to start to really feel the headwinds from those, rising of rates, the pulling back of liquidity. At the same time, we now have the regional banks that are really under stress with some of the recent yield curves and rising of rates and the deposit issues there. So what we see is a slowing economy and definitely a higher probability of recession later this year as we raise rates, draw back liquidity, and that could ultimately, hurt the jobs market. And obviously, there's been excess consumer savings from all those pandemic stimulus and liquidity. We're starting to roll that off. So it feels like we're entering a more dangerous cycle in that liquidity economic environment as we get into the back half of the year. And so we're consistent with that view. And if anything, it could be more severe than we thought, given the regional banks are an important part of lending in the economy, and they're going to have headwinds.
Understood. Probably a little bit more pessimistic than what some of the other views out there, but that makes sense. But given that uncertainty that you see, what investment characteristics do you think are most important to look at when you're evaluating companies and equities?
Right now it's really about robustness and resilience. And when we look at companies, we want companies that full cycle through economic cycles, have sturdy top line businesses, but at the same time can generate cash flows. And we avoid companies with a lot of debt. So clearly when rates go up, that's hard on companies that rely on debt and rates. So for us, what that means is looking at, a company like a John Deere and Precision Agriculture, Microsoft and Google and high quality, innovative life sciences companies like Danaher and Thermo Electron. So just really solid businesses that are more insulated from the economy because they're really embedded in secular themes that can continue to show growth, David, despite, a slowing economy.
Yeah, that makes sense. You mentioned the recent stresses facing the regional bank system, stemming largely from that rapid rise in rates that we've seen. Speak a little bit more about how you view that playing out in the broader economy or the broader markets.
Right. So when we think about regional banks, they are a major chunk of lending, not just for commercial real estate, but residential as well. And so we think there's going to be a headwind to liquidity and money supply growth, which is really important in the economy. At the same time, we have consumers rolling off those excess savings that they had from the pandemic. And so how this really plays out, we think, is that you see headwinds in liquidity, headwinds in lending, rolling off excess savings, and that has a weaker consumer going into third quarter. And so what that does is that would most likely cause some headwinds to GDP and obviously headwinds to, areas in real estate, commercial real estate, and very cyclical parts of the economy. And so again, liquidity is so important and debt is so important and the cost of that debt. And those are all, headwinds that are going to be accelerating in their severity because of the lag effect from raising rates. And we've been a bit more insulated this cycle because so many people locked in very low mortgages the last several years. And so the good news is that we don't have as systemic of a problem as we had in 2008 when a massive amount of homeowners had negative equity. Right now, we have a lot of homeowners with positive equity and have low rates locked in. So that's the good news. The tougher news is that on the margin, the pullback in liquidity, higher rates, and pulling back regional banks, along with those excess savings from the pandemic rolling off, makes it a tough environment here for a bit. And so we want to be, thoughtful and defensive and kind of avoid excess cyclicality right now.
I think a lot of advisors and their clients are hesitant to invest in equities now just because of a lot of the conditions that you laid out. What would you say to them? What do you see as the opportunities or the risks? What should they be looking for in the equity market? Any headwinds or tailwinds? What advice would you give?
So we believe being fully invested is a way to compound wealth responsibly. I've been honored to have been in the business going on 28 years, managing the Parnassus Core Equity Fund for 22 years now. I've been through many cycles, and it's impossible to know the bottoms of markets and tops. Anyone who can do that consistently, good luck to them to do that. But we think is like long-term compounding value. So what I would say is own high quality companies that full cycle can generate returns. And so over time, markets have a tendency to move higher, and people have a tendency to get bullish and bearish at the wrong times. And so what we do is stay fully invested in high quality companies that we think can compound through cycles. So what does that mean to us? Like, what opportunity do we see right now? Think about software. Software is, ubiquitous in the economy. And you think about companies like Microsoft or Salesforce, which are in all those CRM and customer management software, companies like Adobe and digital content creation, companies like Oracle that have all those databases. These companies have recurring revenues, are gaining share in the economy, generate cash flow, have really strong capital structures, and they can grow cash flow through this cycle. And now you have, when you read about artificial intelligence and machine learning, these incumbents actually have great opportunity to benefit from AI without paying the, kind of soaring prices you're seeing in some of the areas of the NASDAQ. So for us, we're seeing long-term themes, but these are companies that we think can grow cash flow even in a tougher environment. And so that's where we see opportunities. Other areas are, we've talked about volatility, rates, equity markets, the economy. For example, we like the exchanges. So think about CME and ICE. These companies trade bonds and metals and mining and equities and risk. When you're in a period of heightened volatility, those exchanges do better because people want to hedge more risk. So for us, it's about active management, looking underneath the surface and buying companies that we think are resilient. A third one I'll give you is AutoZone. We all know AutoZone. They have the auto parts. It's a super wide moat business. They have network effect, all those connections with repair shops and dealers. They get people the parts when they need them. But the thing about AutoZone is that 85% of their sales are non-discretionary. Your car breaks, you got to fix it to go to work, or you got to fix it to pick up your kids from sporting activities or wherever you're going. So think about that business, gaining share, resilient. 85% of the business is fixing and repairing, have that pricing power. So now we're building a portfolio. Think about software, secular winners. Think about companies benefiting from volatility. They're fantastic businesses. Think about AutoZone, resilient, got to fix your car. So if you find 40 high quality companies, interest rates may go up, they may go down, we may have a hard or soft landing, but those companies are built to last.
That's fantastic. Good advice. Thanks very much. Todd Alston, our Chief Investment Officer and Portfolio Manager at Parnassus Investments. Thanks very much.
Thank you so much.